Recording in progress. All right, so welcome back. Yeah, so we look at the margin level, which is equity over margin times 100%. All right, so I will still show you from MT5 how this works. Just I want you to get the understanding of everything before I show you from the MT5. Now, like I said earlier, there are so many calculators out there, right? That is going to help you to be able to do your position sizing very well. So we have the Forex calculator, we have the Nash market. So I will be showing you from my tablet. I'll be walking you through my tablet how you do this, right? But just a quick info here. So you can either get this calculator on Play Store or App Store, right? This is one of them. So there is still another one, which is Nash Market. So I'll be showing you the two. I'll be showing you how to use this and also how to use Nash Market. And also, I will also show you how you can do this calculation with your MT5 without using calculator, right? So just stay with me. I will show you everything. Now, if you're using this calculator, right, if you want to do your position sizing, so first thing first, you need to choose the account currency, right? Then you choose the symbol. Then you have to put in the account balance, right? Then you put how many percentage you want to risk. Now, depending on your risk, whether if once you put how many percentage you are risking, automatically it's going to calculate the amount, right? Then you put your stop loss. You put your stop loss. So from your from your analysis, right, you can be able to get your stop loss. Right? Let's say for this trade that is currently running, right? So this is a sell setup, right? This is a sell setup. So that means for this particular trade, the stop loss is 17. So it's from your analysis that you'll be able to know where is your stop loss, right? So I'll still explain this more. So when you are going to put the stop loss in pips, right? Like from what we have here, the stop loss in pip is 17, right? So the same thing happens maybe if you are trading another, let's say if you are trading an asset like BTC, right? So I have a trade currently running on BTC, right? For this trade on BTC, the stop loss in pip is this number, the one is 100312. Right? So once you put the stop loss in pip, right, you are going to click calculate. Now, the thing about this calculator is that for you to actually use it, you need to have an account size. Like for the calculator to be able to give you value, right? You need to have an account size of $200 and above, right? So that's why I say that I'm still going to teach you the other way you do it on MT5. Maybe for people that have maybe $50, $100, right? So the other way around can help you to calculate your position without using the calculator. So once you click on this calculate, it's going to do the calculation and give you the lot size to use. Now pay attention to this column, I circle that has standard lots. So that is the column you pay attention to. So that means for this trader now, right, that has $10,000 in his account. So he'll be trading with 0.4. And based on our understanding of the various types of lot size, right? So 0.4 falls under where? 0.4 falls under the mini lots, right? Because the mini lot is from 0.1 to 0.9, right? So that means for a trader that has $10,000 and he wants to risk 2% of his account, so you'll be trading with mini lot. So he can't trade with standard lot since he just want to risk 2% of his account, right? So you see that with this calculator, you already know how much you are risking. So that means what is at risk is $200, right? So we already know how much you are risking ahead of time. So with this, it's going to position, you're going to help you, you're going to help calm your nerves down. The trade should be going against you. So more on this calculator. So I will go over to my tab, right, and show you, walk you through how you calculate it and how you can change various parameters. So stay with me. Now the question now is which lot size type to use, right? Now in lot size, we have various types. So we have fixed lots, we have fixed amount, we have market money, and we have fixed percentage. Now, if you watch the calculation we did here, we are using 2%, which is like a fixed percentage, right? So now the 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 type of lot size to use, one, it depends on your personality and again maybe your purpose of trading that account, right? But if I should advise you, or if I should give you an advice, always work with fixed percentage. Why? I will explain it better in the next slide so that you are going to understand the importance of using fixed percentage. Because fixed percentage gives you adjusted adjusted risk, and this is appropriate for new account. Now, you can write this boldly, right? If you are using fixed percentage, if you are using fixed percentage, you can never bring an account to zero. If you are using fixed percentage, you can never crash an account. If you are using fixed percentage, you can never crash an account. What I mean by fixed percentage, when we say something is fixed, so that means if you decide to be using 2% in that account, you will use 2% all through. You are going to use 2% all through. If you want to be using 1%, you are going to use 1% all through in that account until maybe you reach a target. So if you are using fixed percentage, you can never crash an account. You can never blow an account. So you can write it boldly, right? So if you stick to the rules I will give you, I'll be showing you in this section, and you use fixed percentage and you stick to the rule, if you use fixed percentage and blow an account, come back, I will refund you. Right? Now, when do you use fixed lots? Right? Now, fixed lots is good for smaller account. Maybe if you have $100, $50, you can decide to be using fixed lot, or maybe 0.001 or through until you reach a particular target. Now, fixed amount, let's say that you have a certain goal you want to meet. Maybe let's say that maybe I have an item I want to buy, right? But instead of me dipping money into my account, I can just decide to look for a good setup. Maybe let's see, if the item costs $500, I can decide to look for a good setup, right? I can reach $100 on that setup. With 1 to 5, I'll be able to get $500 back from that trade, right? So this is the only time personally I use fixed amount. Maybe if I have a target, if I have something I want to do, right? But I don't want to touch touch money in another place, right? So instead of just spending the money, okay, I'll calculate, okay, the price of this thing is so and so, okay, how much of this money can I risk? And if I should, what is the RR that will give me that money back? Right? Then we also have what we call the market money. Now, market money is good for pyramid trading, right? And maybe as you progress or grow, you might be hearing of stacking, people stacking trade. right? So market money is good when you want to start trades. So maybe the market has already gone in your favor, right? You've already removed your capital. Then any other position you are opening the position based on the profit you have running, right? So that is the only time market money is good. You use it for pyramid trading. But professionally, it's always good to work with fee percentage. It's always good to work with fee percentage. So using the fees percentage, it also gives you the smallest drawdown, right? It gives you the smallest drawdown. And like I said earlier, if you are using fees percentage, you can never crash an account, right? Because it works on what we call it's also on what we call compounding interest. That is when you are profit, and also on discount factor when you are in losses. So I will explain this in the next slide. Now, take for instance, right? So if you are a trader, if you are a trader that is using this percentage, right? Let's say that you are risking one. Let's say that your account balance is $100, and you are risking 1% per trade, right? Now, this is for a trader that maybe you have 10 losses at a stretch. You have 10 losses at a stretch. So that means out of 10 sample of trades you take, there is none that is profitable. So there was none that is profitable. So all of them are losses, 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 losses. Now, but you agree with me that a trader who actually understand or knows what he or she is doing, right, can never have 10 losses as a stretch, even without a single win in between, right? But let's just say that this trader have 10 losses at a stretch, right, without any win in between. If this trader is using fees percentage or $100 account, and he's risking 1% per trade, so that means by in the first trade, he's risking 1%. So that means the loss in the first trade is $10. So he has $90 left. Now in the second trade, remember he's risking $1, right? So in the second trade, he's risking $1. Oh, sorry, he's risking 1%. So 1% of $90, right? So 1% of $90, and the market also goes against him. So he only has $81. Now the same thing again. He also in the third trade, he also risking 1% again, right? So sorry, he's also risking 10% again. So he's risking 10% per trade, not 1%. I mean, so in the first trade, he's risking 10%. So 10% of 100 is $10. So in the first trade, he lost $10. He now has a balance of $90. Now in the second trade, he lost since he risking 10% of $90 in the second trade is $9. So he has a balance of it's $1. Now in the third trade, he's risking 10% of 81. Now 10% of 81 is 8.1. So he has $72.9 left after the third loss. Now do this calculation, right? On your own, just calm down. Do this calculation. Now this is the for 10 trades. Now do this calculation to 20 trades. You see that this $10 can never go, this $100 can never go to zero, right? So this table here is for the first 10 trades. On your own, just do it 20 trade, you are going to see that this $10 can never go down to zero, right? So this is one of the discoveries, right? I have in my trading that actually a kind of change the game for me, right? When I discovered the importance of using fees percentage risk, right? And that is what I use mostly, right? That's what I use mostly. I only use fees amount when maybe when I have a particular target I want to just shoot right now. So this trader he's losing 10% per trade for 10 trades. And after the 10 trade, he couldn't crash this $100. So he still have like 34.85, 34.8, $34 85 cents left. Right. So when you are using fees percentage, when you are losing, it works on what we call negative discount factor. Right. So this is when you are on a losing trade. Now this is the beauty now. When you are on a losing trade, it's working on negative discount factor. But when you are on a winning trade, right, it works on compounding. It works on compounding. Now let's also take scenario whereby this trader has 10 trades. And out of these 10 trades consecutively, right, all of them are in profit. Right? Out of these 10 trades consecutively, all of them are in profit. Now, since he's risking 10% of his account per trade, right? Now, in the first trade, he made 10%, which is 110. The second trade, he made another 10% of this 110, which is 11. They totaling it to 121. So when you do the calculation, right? So this is for 10 trades. So at the end of 10 trades, this trader has $259.33, right, for 10 consecutive trades. Now, this is for 10 consecutive trades, right? So he's having this. So if imagine doing this for 20 trades on your own, do it for 20 trades and see the beauty of fees percentage risk. So whenever you are winning, it works on positive compounding effects. Now there's what we call success rate and expectancy. Now, when you understand success rate and expectancy, you are you won't actually pay attention to you won't actually pay attention to your strategy being 90% or being 100% or whatever. So it's all about the success rate and expectancy. So success rate simply means the percentage of the trades that goes to take profit, right? So so for you to calculate your success rate is the winning trades over the total trades times 100%, right? The winning trades, the ones that are in profit over the total trade you've taken times 100%. So when you do that, you'll be able to get the success rate. Now, a strategy can have 90% success rate, right? But if it has a bad risk to reward ratio, that strategy is a bad strategy, no matter the success rate. If the risk to reward ratio is bad, the strategy is very, very bad. It's very, very poor. So that is the importance of expectancy. Now, for instance, this is a trader that at any time he makes profits, right? He's making $100. So this strategy is 90% success rate by looking at 10 trade samples. Now, in all the 9 trade, he was successful. So he has like mm, 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 in all the 9 trade was successful. So that is like 9 times 900, right? Then, but now only one trade, right? Only one trade spoiled the whole show. Only one trade spoiled the whole show. only one trade made him to still be a loser, right? So if you calculate the 100 by 9, so the like 100 by 9, sorry, $100 by 9. $100 by 9 should give you 900. Then this is $1,000. All right. So guys, let's say that at each point he's making profit, he's just making $100. Whenever he's losing $1,000. See that even though the strategy is 90% success rate, the risk to reward ratio is very, very bad. So this trader can never be can never be profitable in his life. No magic self will make him profitable. Right. So for you to calculate the expectancy, is the success rate times take profit. Now for this trader, the success rate is 90%, right? So the 90% times, sorry. So the 90% times the success rate minus, so the minus 10%, right? Because 90% plus 10% will give you 100%. So since the successful trades are 90, then that means the losing trade is just 10%. Minus the failure rate times stop loss, right? The failure rate is 10%. So if you do this calculation, you are going to see 90 times 100, that is 90 times 100 will give you, let me bring my calculator. All right, so this is 90 times 100, right, minus 10 times 1,000. That is the stop loss, right? So you see that you have sorry, I think let me change it to scientific calculator. Let me redo the calculation. So this is 90 times 100 minus 10 times 1,000. Sorry, 10 times 1,000. Just stay with me. Let me redo the calculation. So this is 90 times 100 minus 10 times 1,000. So you see that even though that this strategy, right? Even though that this strategy has 90% success rate, is a bad trading system based on the risk to reward ratio. Now let's look at another scenario, right? So this is a strategy with 40% success rate, right? But it has a good risk to reward ratio, right? It has a good risk to reward ratio. Then at the end of the day, when you calculate the expectancy by taking the success rate by take profit minus failure rate and stop loss, we are going to see that even though that this strategy has 40% success rate, it was a good strategy because it has a good risk to reward ratio. So at every point in time, this person is making profits, making $1,000, and at every point in time, he's losing $100. So I will see we still talk more on risk to reward ratio. All right. So Now, when you use lower leverage, right? So when you use lower leverage, it's going to reduce your exposure to risk, right? Why when you use higher leverage, it's going to increase your your exposure to risk, right? So let's look at risk to reward ratio. So in the next, I think this meeting is becoming long. Let me just end it so that I will explain. I want to explain risk to reward ratio well and what I call the 10 trades rule. And when you understand the 10 trades rule, you will never be afraid of taking any setup. So stay with me.